Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Feel free to give us a call this morning, 216-901-0945, 216-901-0945 if you have any questions. And I think we've got a pretty interesting show today. We're going to be talking about tracking your investments, making sure you're staying on track, look at your financial plans, because we have another seminar scheduled. This one's going to be a Saturday morning. And in the summertime, I like to do them Saturday mornings because I know it's hard to get people to go out in the evening. It's going to be Saturday, July 22nd. It's going to be at 8:30 in the morning, Corporate College East, same place we always do our seminars. And just got to love that facility out there. Such a nice place to host a meeting. And we'll have a continental breakfast. There's no cost to attend. Seating is limited, so you need to get there. Because we're going to be looking at something that we've been working on for a little bit. We're going to unveil some financial technology that'll help you stay on track with your investments and your financial plans. And it's going to do it all in one place. You know, we've tried this actually a couple times, incidentally. And the software, quite frankly, just wasn't ready for prime time. It required way too much effort on our part. So the firm that I'm going to be using is a firm that was actually acquired by Fidelity Investments, and Fidelity, with their resources, has put a tremendous amount of money into this, and I think it's going to be a really kind of a cool thing. And I think finally, this is actually, we've been trying to do this for years. I don't know if you've ever tried one of those account aggregators where it pulls in the values of all your accounts wherever they are, checking, Visa, MasterCard, mortgages, all that kind of stuff. They're always working. Not working. The links are always breaking, and you're spending so much time. It gets so frustrating that you just say, forget it. Well, I feel your pain. We've been in the same place. And I think, by George, I think they've got it this time. Not that it's without effort. There's some effort setting it up. But once it's set up, the maintenance on it is not nearly as difficult. And I think this is going to be a great tool, actually. It's kind of like a dashboard, a financial dashboard that Bullington Capital is going to make available to its clients, where you can log in, see everything you have. Even, let's say you have some real estate and there's no public, you can't look up the price in the paper, but you can come up with an estimate of what you might think it's worth. You can put that in there. So it's really kind of I'm excited about it. It's a lot of effort, I will tell you that for sure. And my poor staff, because we're all in it together. So I think it's a really good idea. It's a great idea to keep you on track. You can come in. If you see a transaction you don't recognize, you can look into it right away. And pulling it all in one spot, like I said, I've been trying to do this over the years. At least 4 or 5 times. We've taken different trials. This last trial, I think, like I said, I think they got it. So pretty exciting stuff. And we're going to have this seminar in the morning. We're going to show that technology. It'll bring in the assets from the custodians that we use. It'll bring in assets from your 401k plan. You have other accounts, maybe your trading account that you you do yourself. That's awesome. So anyway, that seminar, again, it's on the 22nd of July. That's a Saturday morning, 8:30. Just go to bullingtoncapital.com to sign up online. No cost to attend. Seating is limited. So, and aside from that, what we're going to talk about first this morning is the huge cyber attack that was launched on Friday. I mean, I thought it was just my computers, but we're going through the office and everybody's computer is like unbelievably slow. I mean, unbelievably slow. And I was just so upset. I'm thinking, oh man, it's got to be my internet service provider. And we pay a lot of money for a fiber optic line to have super fast connections, and something's wrong there. Well, anyway, today's Wall Street Journal. I look it up, and hackers actually launched a global assault. That's what the problem was. Wow, that's amazing. And see, this is interesting. So I don't own Apple stock, by the way. At least I don't right now. I haven't owned it in the past. You know, I shouldn't say that. It might be in one of the models that I run. That model holds 100 stocks, so it could be in there. I should preface that by saying it might be in the portfolio. So anyway, the Apple products weren't targeted. These were primarily Windows-based computers, and I was wondering why my Mac was working so well, and then I turn around and I'm using my Windows-based PC, which our office runs on, and that sucker is like it's like a snail's pace. So I was upset by that, and I'm going, man, what the? And I kept thinking that it was probably just the internet connection, or maybe there's a big update that's running in the background, and it was just a coincidence that all four of us in the office there are having the same problems. And then this morning we find out that hackers were launching a global assault and were disrupting, and they were targeting the Windows-based computers. So I guess in a way I feel better that it wasn't my machine that was messing up. It wasn't our machines in the office, nothing that we were doing. And in fact, everybody was suffering from it. But anyway, that's the world we live in. It's amazing. It's absolutely amazing. Every time I look around, I'm just, I guess amazed is the best word to choose. Things are so complex, but they actually work quite well. So you have a massive hacker assault. It's not that you couldn't do anything. It was just that it was slower. It was back to like when you used the old modems that made all those nasty noises when you logged onto the internet. The speed was still faster than it was back then. Think about that. You're under a major hacking assault, entire world, and you're still running faster than you did in the mid-90s. That's progress. Yeah, that's big progress. I feel bad for all the kids who in the mid-90s were still in elementary school because they don't understand anything about that. They just think that this is really, really bad. Hey, dude. Yeah. Okay, well, I remember the first time I downloaded a picture of the Earth that was sent from a satellite from NASA, and it only took 45 minutes. And I remember thinking, how cool. How cool is that? Nobody had video. That all your message boards were all text. It was crazy. And to think of how far we have come and where we're going, I think it's a beautiful thing. Anyway, we had a workshop this week. Thank you to everybody that came out. And I really, I guess one of the points I really wanted to make at that workshop was that the projected numbers when you do an asset allocation, the projected numbers that the vast majority of investment advisory firms are using data that's based purely on historical data. And I don't think history is going to repeat itself. In fact, I'm pretty sure it's not. It's not going to repeat itself like it did the last time. And the thing that really sticks out in my mind is fixed income. You look at the long-term average return of fixed income, somewhere around 5 or 6%. That is not going to happen. And so you take a typical asset allocation that comes from a big vendor that everybody trusts, and they're using that data, and it's showing you a 5 or 6% return on fixed income, and it's probably more likely going to be 2% or less. Now, see, here's where the problem comes in. If I have 50 or 60% of my money in fixed income, and I'm expecting a 5 or 6% long-term return, and I get 2% or less, can you see a problem there? You did a budget based on 5 or 6%, and you're only getting 2. So if you had $1 million and you're expecting $50,000 to $60,000 in income, and you're only getting $20,000, can you see what I'm talking about? That's a problem. It's a big problem. It is not being addressed by the vast majority of the investment advisory business. Very few people are talking about that. They don't want to talk about it. You know why they don't want to talk about it? Because they're afraid that you won't invest. So they'd rather put you in something that's higher risk so they can get paid. And that is just, that's not good. That is not good. So let's take a more realistic judgment, and that's some of the paperwork that I handed out. There's a method of forecasting future returns. None of them are going to be perfect, by the way. Forecasting perfectly is impossible. But that being said, some ways are better than others. Okay? And I think this is a very good way. And if you would like a copy of that, I have no problem. Just shoot me an email and I'll send you a copy. I think the projected returns from this company are way more accurate than the historical data would represent. Way more accurate. And I think it's a huge improvement over the projections. And if you incorporate this into your financial plan, I think you're going to benefit tremendously. I'd rather project conservatively than project aggressively. I'd really like to do that if at all I can. If there's any way of doing that. And so anyway, if you'd like a copy of that little, it's a PDF, and it's put out by a company called FI360. It's a company that gives fiduciary training. Fiduciary training I'm taking mainly because the Department of Labor rule is sooner or later the thing's going to get enforced, and I think this is it's a good thing. It's a really good thing, especially when I see them putting out material like this. This is really good material to be put out. I think it's sobering. Now, they look at a long-term treasury fund having a flat return, almost zero. They're telling the truth. They've got the guts to stand up and say, hey, we know the yield is over 3%, but when interest rates go up, the bond price is going to drop. So if you factor in the drop in the price, that 3% is probably going to be eaten up by the drop. And incidentally, over a 1 or 2 year time period, that return can be incredibly negative. You could put $1 million in long-term treasuries or a fund that's investing in long-term treasuries. It's paying 3%. And a year later, it could be worth 10, 15, 20% less than you paid for it. And actually, if interest rates go up fast enough, it can drop a whole lot more than that. And if you want proof, okay, I'm from the Reagan era, by the way. I was just coming of age when he got elected. I was 18 when Ronald Reagan got elected. And he used to say, trust but verify, or at least he was attributed to having said that. Trust but verify. That's what I'm telling you. Trust but verify. Don't take what I'm saying for granted. I'm a nice guy. I wouldn't mislead you, but check out what I'm telling you. Don't take it for granted. Okay. Go to the internet, look up a chart of the Barclays 20-plus year Treasury bond fund. Now, that's not even a 30-year bond fund. That's not the super long-term bond fund. But if you look at that, it was selling for $143 a share back in July of last year. Now it's selling for $120 a share. Think about that. Those are government bonds that they're investing in. Their management fee is a fraction of a percent. So why is it down almost 12% over that time period? In fact, if you go from the peak, it's down 15%. Think about that for a second. And so if you're looking at long-term average returns for that asset class of being 6% or even 5%, and now you're down minus 15, guess what? That's a negative surprise. Why are people doing that? Why? Because they just don't know. And I'm going to give every advisor on the planet a break here. I'm going to give them a break. You ready? They didn't know. Because anybody that was holding something like that that's down by that much over that time period just either A, didn't know any better, or B, they didn't want you to know any better. And now you found out. So I'm going to give them the benefit of the doubt. I'm just going to say, you know what? They just hadn't really managed money before, and they didn't know how sharply government bond prices could drop. I mean, if they knew that, okay, would they have recommended that product? Absolutely not. Yeah, so I'm going to give them the benefit of the doubt. They just didn't know. And it may not be over. I mean, interest rates just started creeping up. GDP growth is creeping up here and overseas. And as the economy starts to grow, as it continues to heal, even though this has been the longest, slowest recovery in the history of the country, it's still recovering. It's still growing. So if interest rates continue to go up, guess what's going to happen to the prices of those bonds? They're going to continue their drop. So if you're suffering something like that, feel free to give us a call in the office. I'll tell you what I think you can do about it. And I'll give you the background, the information that you can look up just to verify. That worksheet, I think, is a big part of it. And kind of interesting too is that the method on the bulk of the method that they're using was written about back in 1989. I think that is hilarious. It was written in 1989, but nobody was listening. I've seen that happen so many times I can't even tell you. So now, and these guys are some of the first to come out, the first that I've seen. And by the way, I'm looking all the time. I look at what the analysts have to say. I listen to the people that are out purveying the product. All these fund companies, by that way, they have sales reps that they put in the field to come and talk to people like me. The sales reps don't talk to the general public, nor will they. But the sales reps also have access to the portfolio manager. So you get to basically hear what they're thinking, you get to ask the tough questions. And when I have been asking the tough questions, I can't tell you that I'm extremely excited about the responses. Not excited about it because nobody wants to, they really don't want to admit what is out there. And they will. Some of them will. In fact, some of them are pretty upfront about it. Now, they don't volunteer the information. You have to add. You have to know which questions to ask. But when you ask them, there's some of them out there, and I admire them for that. They say, well, this is what we think. And, you look at the potential total return, and it's almost zero. It's almost zero. So bonds, although they are adding a very important mix because they tend to not fluctuate quite as much, especially if they're not long-term treasuries. Those fluctuate as much as stocks do, incidentally. Or can, anyway. But if there are certain types of bonds that don't fluctuate that much, they're shorter term in nature. I think CDs right now. I looked at his 5-year CD on one of my custodians, and it was 0.25% higher than the nationally advertised rate of the highest CD rates. So that's pretty cool. Hey, you know what? I hear the music. That means I got to take a real quick commercial break. This is Bill Bullington right here on 1420 The Answer. Stay tuned. I'll be right back. And we're back. Hey, you got a question today? 216-901-0945, 216-901-0945. This is Bill Bullington. I'm here every Saturday morning from 11 to noon, 1420 The Answer. Also, tomorrow night, 12:20, they'll replay this show. So if you missed it, if you miss both of those places, you can actually find it up on Apple iTunes as a podcast, the Bullington Capital Report. You can go to my website, bullingtoncapital.com, or you can go to the Fish's website, 955thefish.com, and it's all over the place. It's pretty funny. I listen to my show fairly frequently, not actually fairly infrequently because I can't stand the sound of my voice. Yeah. And I'm not really sure why anybody would listen to it, except that I do cover topics that aren't getting covered by the popular media. Like, for example, the fact that bond prices are probably going to continue to drop or stay flat, and the yields are not very high. And what do you do about that? Well, I think a viable alternative today is you might want to look at CDs on a secondary market. There is a secondary market for CDs. What do I mean by that? Well, a primary market is when you go to the bank and you buy a CD from the bank. That's primary. You're dealing with the primary dealer, which in this case is the bank. You're going down to whatever bank it is, and what kind of rates do you guys have? And a lot of people like to get online now and try to shop it that way. There are a couple problems with that. First of all, you can only put $250,000 in that account and have FDIC insurance. That could be a problem. Because if you get over $250,000 and the bank fails, well, we know what all happens when We all know what happens when that works out that way, and we're hoping that's not going to happen anytime soon. We'll knock on wood. But that's one of the problems, and you have to have all these accounts. So what is a CD that you buy in a secondary market? Well, a secondary market is a big brokerage firm that goes out and buys and sells CDs from banks. Now, why would they do that? Why would a brokerage firm buy a CD with the bank? Well, because the bank has this money locked up in this CD, and they need the liquidity. They need cash to make a loan that they've got a chance to make a better return on. But they have certain requirements that they have to meet. So instead of just passing on those loans, they can go to some of these dealers, big brokerage firms that have money. They'll sell them the CD, and they'll even take a little haircut. They'll take a discount on the value of the CD in cash. So let's say they got $1 million, and they'd like to make $1 million loan. They might go and say, okay, we will take 0.1% less than $1 million. We'll pay you the $1 million that we owe, but you only have to give us $990,000. That $10,000 at 1%, we're going to make that up on this loan. So you guys take the CD, give us the cash. We're going to make this loan. We'll get our money back and then some. So that's kind of how that works. The banks actually go and sell their CDs to a big brokerage firm that's got big enough pockets to buy those things. And then the brokerage firm turns around and sells it to the general public. And they're probably going to sell it to the public for slightly more than they paid for it. And in the process, the interest rate on that loan is actually a little bit higher than the CD was paying that when it was issued by the bank to begin with. Why? Because they took less money for it. So I know it sounds pretty complicated, and it can be, but essentially what these big brokerage firms do is they go in and buy CDs from banks and then offer them at a discount, and then they offer them to their clients. Okay? And they share some of that discount with their clients. That's how you can get a higher rate than you can get on typically, not always. Okay. But if you shop around, oftentimes you can find rates that are higher than the nationally advertised highest rates in the country. That's pretty cool. Okay. And like I said, it's not always. But if you can't find something that's better than that, then just wait. Those things change every day. In fact, CDs are bought and sold constantly, and which surprises a lot of people. And when I first found out about it, I was surprised. Wow, who knew? So here's another advantage to doing something like that. You can have $10 million in a brokerage account, and as long as $250,000 is the limit that you've in CDs that you've purchased from one bank, it's all FDIC insured. Now think about that for a second. And the rates, by the way, are higher than treasuries. They're higher than most local CDs, but also treasuries. And you'd actually have to take some credit risk. That means you'd have to invest in corporate bonds by a corporation, who could go bankrupt, in order to get rates that would be higher than these rates. So, if you have any questions about that, just feel free to reach out, contact, email. You can call us, whatever you'd like to do. We'll try to pass on some more information about that to you. And I think it's a good idea. Here's where I think it's a great idea. Let's say you're really nervous about the stock market. You need to make more than a couple % return on your investments, but it's just so nerve-wracking. Okay, so here is a potential solution to part of that problem. Maybe you buy enough CDs that if you're taking out income, that it's going to last for at least the next 5 years. 5 years, you've got locked away in CDs that are going to mature once each year to provide the income that you're going to need. Now, you can do it 5 years or even 10 years. So let's say you're going to do it for 10 years. 10 years, you're going to lock up your CD rates, and every year a CD is going to come due to facilitate your spending, and that's what you're going to do. You're going to live on that. You're going to guarantee that for 5 or 10 years, whatever you feel comfortable with. Okay. In the meantime, you can invest in a broadly diversified basket of stocks, whether it's individual stocks or ETFs or mutual funds, however you do it. Okay. And that gives you 10 years of peace, of better than average sleep. Yeah, that might work out really well. It might work out really well for you. And most of the strategies, well, all the strategies that I use have never had a 10-year negative time period. Now, that's not a promise that won't happen in the future because nobody knows. And I'm always fond of saying anything can happen and probably will. The S&P 500, on the other hand, has had multiple 10-year time periods with negative returns. That would not be a good bet. I would be totally uncomfortable putting into the S&P 500 or the Russell 1000. Those are market cap weighted indexes, something I probably won't talk a lot about on today's show, but I will talk about it in the future. We're going to put out a couple of videos on it. I've already cut the raw material. We just haven't edited it to put it up online yet. Yeah, but that is not my favorite way to invest, particularly if you are retired or nearing retirement. If you're 20 or 30 years old, hey, go for it. But if you're close to retirement and you are uncomfortable knowing that you could be negative 10 years or longer, and it's already happened multiple times in those investments that you're considering investing in, okay, then maybe you should get another plan. And that's one of the things we do. Investment planning, by the way, has such a small, people don't pay attention to that. It's like the number 2 thing you can do on a financial plan is plan your investments. We'll come back to that in a few minutes, but right now I want to take a quick phone call, and I've got a question. Hello?
Yeah, hi, Bill.
That's me.
Hey, real quick, I was perplexed by your analysis there of the CDs and the bank selling it to a secondary market of brokerage firms.
Uh-huh.
Isn't the money already at the bank? Is it locked down when they offer a CD, and therefore they can't use it to just give the business loan directly? They got to sell it to the brokerage firm in order to get liquidity?
Absolutely. Well, they have other methods of raising capital. That's just one of them. That's just one option.
Okay. No, I never knew that, meaning I just assumed that if I had a lot of money in a CD with the bank, that they're giving me 2% or something, but they're able to take that money and loan it to somebody else for some other purpose, house loan, car loan, business loan, whatever, and make money off it. But it's sort of locked down. They can't do it that way. They got to sell it to a brokerage firm before they can.
Well, see, if they've already lent, if they've already lent the maximum amount that they've lent against the CD, the assets that the bank holds, they've got to find liquidity somewhere. So if they can pass off that liability to another financial institution and then receive cash for it, it frees up a little bit of the cash that they have available to make those other loans.
Got it.
And it's mind-boggling. I mean, a fixed income market, short-term commercial paper, repos, reverse repos, there's all kinds of things they do. In fact, it's another world altogether. But the benefit for the individual investor is that you can have a brokerage account where you shop for CD rates all around the country, and you can have way more than $250,000 in CDs with FDIC insurance in one account. You get to see it. Yeah, that's pretty cool.
No, that is, because I know some people who've had to have, you got $1 million, you got to put it in 4 different accounts in order to maintain the insurance.
Yeah, that's actually they would need like 40 accounts at $250,000. with that would be tough. That would be really tough.
In a big discussion on bonds today, I've been a treasurer and president of a local nonprofit group, and we've had some excess cash that we've had to invest in, and you're always looking for safe returns, and we're not allowed to participate in the equities market. We've gone into bonds, but we've done it in a way in which we buy the bond directly through the bank or through the brokerage firm. I forget who we were using. And the end result is we hold bonds to maturity, so we don't have to worry about what happens to the price of the bond.
See, that's because your institution doesn't have a life expectancy.
Yeah, that's true.
Yeah, so it can hold it until they mature. That's a beautiful thing. But if you look at the rate of return between the time that you purchase the bond and the time it matures, depending on how long the bond is, you're going to see that those numbers, those current balances, are going to fluctuate wildly if you're holding long-term bonds.
Yeah, and these aren't 30-year. These are because our liquidity needs are such. We have some programs in which we've got to hold for 15 years.
Right.
So we spread them out between 5 and 10-year bonds and treasuries.
Yeah. Yeah, that's a very good thing, and that's what I'm saying. A lot of people should do for themselves. If you are looking to take, and you have certain cash flows and you have certain expenses coming up, you can price or buy the bonds with the maturities that match that, and then you do not have to worry about the principal, assuming that it's got a government agency backing it up or the government itself. If you're buying from a company, now you have the credit risk of the company, but that's a perfect way to do that, and kind of exactly what I was talking about with people taking money, say RMDs. I get a lot of clients who have to take RMDs, and they're worried about it. I don't know, what should I do? Well, here's a solution. It's probably not going to give you the amount of interest that you would like to have, but it'll make sure that the principal is there to pay those payments when you need them.
Correct.
Yeah, so that's kind of the point behind that.
Well, we've been doing this for a long time, and when the stock market crashed in 07, 08, we didn't have any issues because the bonds themselves, we were holding to maturity. We didn't have to worry about a lot of the other nonprofits, some of the community banks that had the grantors, like Cleveland Foundation and so on.
Mm-hmm.
They had monies that were tied in to stocks, and they saw in many cases a 40% drop in their investment.
Oh, absolutely. Yeah, that's going to, and by the way, if you're in stocks, I remember when I was new in the industry, I read this book, or actually it was a quote by Warren Buffett, and I was brand new in the business. And he said in this article, if you can't stand to see the value of your stocks drop by 50% or more, don't buy stocks. I thought he was kidding.
Yeah.
I thought he was just trying to scare everybody out of the market. But he was not kidding. And I soon learned that, stocks are incredibly volatile. Yes, they do have better long-term returns, have had better long-term returns, I should say. But it comes at a cost. That cost is you have to put up with a lot of volatility. And that's assuming that you know what you're doing. Because I would think...
I'm with you. I was with... you and I are the same age, and so I was around 18 when Reagan came in. But as far as I can remember, we've had two significant market changes in our lifetime, which is that October of '86, and then the 2007, 2008.
Well, actually, then you had also the 2000 through 2003. That was a big drop. That was a 50% drop in the S&P. Now, the difference between 2000 and 2007 and 2008, the 2000 was really only a handful of industries whose market values, this is the thing I have against market cap weighting. As Microsoft goes from 25 to 50 to 75, they were adding to it. They were selling money out of other stocks and adding to Microsoft after it had gone up. That's what market cap weighting does. Okay, and then when it crashed, and on all the other stocks, by the way, that was one of the biggest manias, one of the biggest bubbles the country's ever experienced. The stocks that were overpriced just kept going higher because the market cap weighted funds, by their prospectus, by law, must continue to buy them, agitating the problem and making the problem worse. Okay, so that's what I don't like about it. Hey, you can hang on. I have to take a real quick commercial break. Would you like to hang on, or do you want to run?
Yeah, no, I think we're done. But thank you very much for your thoughts.
Well, have a good day. Thanks. You're listening to Bill Bullington right here on 1420. Stay tuned. I'll be back after these messages. And we're back. Hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. You can also find us on iTunes. Just go to search for Bullington Capital Report. It'll come up there. You can go to my website, bullingtoncapital.com, and it is also there. The radio show is there. So if you heard something that you want to go back and re-listen to, and you don't feel like giving me a call, you can go to any one of those sites. That's no problem. You can also go there and sign up for the next seminar. This is going to be a Saturday morning one. I like to do that in the summertime because, I don't know, I just like to do it. So it's going to be 8:30, Corporate College East, and we're going to be showcasing some new technologies that help people stay on track of their investments and their financial plans. So I think that's exciting. It's a lot of work for us. Actually, again, for those of you that our clients know, we tried to do this 3 or 4 times, I think 4 times, and the software was really just not ready for prime time. So I think that problem has been solved, and we're going to take another crack at it because I don't like to give up. We'll just keep working at it, and I think it's really cool. So we're going to show that it's part of the DOL rules. We need to have close relationships. That's part of what they're trying to drive home through all that legislation. Make sure your advisors are working in your best interest. If you can only work in somebody's best interest. Well, I shouldn't say that. The more you know about a client, the easier it is to work within their framework in what's in their best interests. And that has a lot to do with the type of investor you are. Now, I know a lot of people don't know what type of investor they are. They just, go around looking for, the best track record at the cheapest price. And that's not always the best, by the way, because if you look over the past 5 years, anything that's been market cap weighted has had the best 5-year track record. But in the longer term picture, those have not been the best performers. So, and loading up on them now, I'm not sure that's really all that wise, because the past 5 years have been very good to those types of strategies. And in the long run, they have not done nearly as well as some others. So I think the time right now is it's kind of crucial that over the next year or two, it's not something you got to do tomorrow or next week, but somewhere over the next year or two, you should be making some adjustments. In fact, you should always be making adjustments at least once a year, because you're getting older, your life expectancies change, inflation rates change, you get different products available. You should come back and review this stuff at least once a year. That's pretty important. So anyway, 8:30, Corporate College East. That's Saturday, July 22nd. You can go to bullingtoncapital.com to sign up online. There's no cost to attend. Seating is limited, and I think it's going to be pretty cool. Anybody that came out, by the way, to the last seminar, we're going to send you a copy of that PDF that we sent out. I think that's important going forward. If you're making an investment plan, it's important that you come in with data that's as accurate as it can possibly be. None of it's going to be perfect, by the way. But, having said that, there are degrees of accuracy. You want to get as highly accurate as you can. And I really think that I like the method of projecting the returns. It's closest to what I believe is actually going to happen. So if you want to see that information, and anybody calling in or emailing us, I'll send it to you too. It's no big deal. It's a PDF. Okay? And it shows the breakdown of the returns of the asset classes, the major asset classes that you might be considering investing in. And I think it's a very realistic approach. It's really not even that bad. What it does tell you is that if you're relying on fixed income like bonds and CDs, that the rates of return on those are going to be relatively low. So if you look at the percentage of money you have split up between stocks and or CDs and bonds, you're probably going to have to lean more heavily towards the equity investment stocks, okay, than bonds to try to reach your goals. That's all it means. That's all it means. One of the byproducts of that is that you'll have to have higher tolerance levels for fluctuation. The fluctuations are going to be much higher than you would probably like to see them. And one of these days, I hope, just like everybody else does, that we get a 5 or 6% CD again. I'm not sure that's going to happen in the next 10 years. I just don't know. I don't think that the probabilities are high that does happen. I don't know if the GDP growth is going to get above 3% anytime soon. It's actually been below 3% for the longest time in the country's history now. So, and it's really difficult when you're in the position that I'm in. And there are certain strategies that you run that are dependent upon higher GDP growth, and it just hasn't shown up. So first few years, those strategies did very well. Now I'm making adjustments for that. In fact, I'm adjusting to something that's happened over the past, 36 months. The market cap weighted funds have received more of the money than any other funds have. So those funds have done better. Surprise, surprise. It's kind of a self-fulfilling prophecy. It won't always stay that way. There are a lot of good values in even large, medium, and small cap stocks. There are a lot of stocks that have not participated in this, who are generating a lot of cash and are selling at below average valuations. Now, sooner or later, that is bound to kick in. I just don't know how soon or how late. But I do know that there's an opportunity there, and I have a plan to try to take advantage of it. So if you'd like to learn more about any of this stuff, feel free to give us a call, drop us an email, pay attention to the website. It's going to be changing over the next few weeks. And I guess I'll spend at least 5 minutes talking about the Lookout for the Bull website. The Lookout for the Bull website is really, it's for a particular style of investing, and it's really trading. It's not an investment. It's trading. It's long-term trading, not short-term trading. We're hoping to identify companies that have the potential to go up a lot in a relatively short time period. And that's what the whole site is there for. There's a little training section on it. We're going to actually put videos up on it soon. But there's a training section that shows you or tells you exactly what we're looking for. If it takes you more than an hour to read all 4 training sessions, it's because you're being distracted. It's not that hard. The hard part for most people is sticking to it. It makes perfect sense. When you read it, you go, oh, that's it. Yep, that's it. That's all there is. Stocks can only go up, down, or sideways. That's it. You can't predict how far they're going to go. So you better have a trailing stop. And the ones that go up a lot, hey, they're going to be few and far between, but they're there. The ones that go up a little bit and then stop you out, that's going to happen a lot more frequently. And then some of them will stop you out almost immediately. That's it. That's all you got to know. But you need to know how to identify those stocks with the potential to go up very fast, very soon. How do you do that? Well, that's also explained. All the criteria that I use to do my scans are explained on the website. Now, here's what I'm going to do. I'm going to slowly transition this, by the way. I'm going to put up videos that explain and show you step by step how I set up the scans, what programs that I used to set those scans, and what the parameters are. Now, this is a work in progress. Anybody that knows anything about producing these things knows that, yeah, that's a lot of effort. So once we get it up there, if you decided that you didn't want to continue to subscribe to the website, you can quit. How cool is that? I will show you everything. And it's not going to charge you, I'm not going to charge you $3,500 the way that most of these firms out there do to learn that stuff. And then you're going to find out, exactly what it's like. The Lookout for the Bull really means look out for the bull, So anyway, what's very interesting on one of the scans, Valiant, the company that just crashed and ruined a bunch of track records for a whole bunch of hedge funds lately. And one fund that had a 15% a year average annual return over a 40-year time period had loaded up on this stock and it just crushed it, knocked that return down quite a bit. Well, it showed up on the scan, which I think is pretty funny. Looks good, but is it going to keep going? I have no idea. The valuation on it's fairly low. The symbol is VRX, by the way, closed at $13.59. If you want to know why I pulled that up, it's because it has the lowest valuation, the lowest price to sales ratio on any of the stocks that came up on the scan on Friday. And so I'm looking, I go, oh, that is a logical, rational bet, but it is a bet. This is not an investment. This is a bet. Calpine, that is hilarious. A utility stock. That thing's up almost 40% in a week. That's crazy. So something's going on there. It also has an extremely low valuation. It's 0.5. Its price to sales ratio is 0.57 The average for that industry is typically 1.5 to 2. Okay. Got another company, ASIX, AdvanceX. I don't even know what these guys do. By the way, that's one of the things I like about this particular method. You really don't need to know that much about the company. It's either going to keep right on running like it's running right now, or it's going to go down and you're going to get stopped out. One or the other. Adding a whole bunch of analysis is probably not going to help you. Hasn't helped me, maybe a little bit, a tiny bit after you've been doing it for years and years and years. But I got to tell you, I'm gonna have to save that comment for next week. Sorry about that. You've been listening to Bill Bullington. I'm right here on 1420 every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.